Traditionally, classic economic principles always assume consumers are rational when making purchase decisions. But when we look at reality, most of the time people are impulsive and short-sighted. In most of the cases, they are irrational when spending their money. The theory behind this phenomenon is what we call behavioral economics. Behavioral economics argues that people make systematic mistakes as they experience psychological, social, and emotional effects that affect their decision-making process. For example, if the price of a hamburger dropped from $20 to $15, rational people will be happy and buy more of it. While people that are affected by their emotions will not buy the hamburger as they may think that the shop reduced the price of the burger because of a lower quality than usual. In fact, there are many topics that are related to behavioral economics. For example, there are hedonic adaptation, anchoring effect, herd behavior, availability heuristic, mental accounting, endowment effect, and bounded rationality. And in this video, we will focus on talking about mental accounting. So, what is mental accounting? Mental accounting is the tendency that people treat their money differently based on factors such as intended use or its source. The phenomenon of mental accounting can be easily found in our daily life. Imagine you have set a $25 coffee budget every day. In scenario 1, you find at a coffee shop that the $25 has fallen out of your pocket. While in scenario 2, you bought your coffee but then you spill it. Will you buy another cup of coffee? In scenario 1, most people would buy another cup of coffee because they feel the drop of $25 as a loss from their total budget instead of their everyday coffee budget. While in scenario 2, most people would not because they feel like they have already spent their daily $25 on coffee. The economic result is identical. The people's decision changed because of mental accounting. There are actually both benefits and drawbacks of mental accounting. On the good side, people with good self-control can easily manage their accounts for different expenses, like food, entertainment, saving, and transport. They will know how much to spend and how to limit themselves when a particular expense already exceeds the budget. In the long term, having specific goals for specific accounts is one potential positive impact of mental accounting. For instance, if you have an account set up for university tuition fee, savings, and investment purpose, you will possibly come up with a timeline and risk tolerance for each account. Mental accounting helps us to select the most appropriate method to increase the wealth for each account. One of the nice things about mental accounting is that it always reminds us to think about each account and what you're really trying to achieve with it. In other words, mental accounting motivates us to achieve the financial goal for individual accounts. On the bad side, people with low self-control might suffer. They may delay the needed purchase in one category because the budget ran out, but still spends money on other less useful items. Imagine you are saving for something important like a phone, a computer, or even textbooks, but you are still far behind the budget. At the same time, you spend money on some small items like bags, shoes, and games. If you save up all this money, you may already have enough money to buy a phone. Also, people tend to treat certain money like bonus, gifted money, lottery win, and refund differently from earned money. It's easy for people to misidentify this extra cash for them to have fun with. It's because most people find it easier to justify spending it on something less important instead of adding it to your savings. Now that we have talked about the disadvantages of mental accounting, what can we do to overcome it and manage our money better? First, we should review and monitor our budget regularly. By doing so, we can keep track of our daily expense and accounts to avoid overspending due to mental accounting. Second, we should always plan ahead and anticipate the unexpected. Always be prepared for some sudden income and plan on splitting the income in different ways, like savings and settling outstanding debt. Last but not least, set a specific financial goal and always keep it in mind. After all, the problem that mental accounting brought is the confusion of what you want and what you really want. You know you want to pay for a master degree program in 3 years' time, but a concert of your favorite pop singer and a newly released phone sounds good also. How can you resist the temptation? Having a clear goal in mind helps us to think carefully before spending and ultimately minimize the impact of mental accounting.